Hello, everybody, and welcome to the third quarter market review, where I will review the most recent quarter performance for U.S. and international equities. I'll dig into various asset class performance, including commercial real estate and fixed income, and I'll also review how various diversified portfolios perform. And because we still have about 3 weeks to go in this crazy election season, I'm also going to share a couple of slides on how the market performed under different administrations. Once again, I'm Sergio Mariaca, president of Mariaca Wealth Management, and just like all of my other videos, I try to break down some of the key principles around investing in a way that is understandable so that hopefully you can be a more informed and disciplined investor. Now, before I get started, I have a bit of housekeeping to get through. First and foremost, I'm going to be reviewing historical performance, and I need you to know that past performance is never a guarantee of future results. Next, everyone's situation is different, and this information is for general purposes only. It does not constitute investment advice or a recommendation of any kind. So I think we can all agree that 2020 will be one of those years that we all want to forget, but somehow won't be able to. Of course, I'm referring to the pandemic, the social unrest, the fires out west, the hurricanes in the Gulf, and just about the craziest presidential election season many of us have ever seen. Oh, and we have murder hornets too. And because of all of this, it has been a crazy year for investors who have had to weather extreme levels of volatility across global equity and asset prices in general. And from an economic perspective, the U.S. and global economies are still suffering as we continue to navigate through the pandemic, and we are now seeing signs that the recovery may even be slowing, as evidenced by today's Department of Labor report showing initial unemployment claims of 898,000, which is about 53,000 more than last week and also more than the 4-week moving average. That means that right now we have about 25 million Americans out of work. So as I review the recent market performance, we need to recognize that the broader economy and the recovery are still quite fragile. I'll have more of this in the presentation. Let's go ahead and get started by looking at the last year. Okay, we are looking at global equities from the end of the third quarter 2019 through the end of the third quarter 2020. Here is 2020, starts right around there. That's December 31st, 2019. What we can see is, global equity markets are doing pretty well as they cross into the next decade. In fact, 12/31/2019 was the end of a decade. U.S. stocks closed up 190%. Somewhere here in January is when China discovered COVID-19, and we found out soon after. In any event, somewhere around here on February 12th, the Dow hits 29,550. That is super great news. Highest point ever right before this massive capitulation. And here is the lesson. Like huge stock corrections, we don't ever get any good, reliable advance warning. We also don't get a warning when the market recovers. So if you started to see your equity exposure, hopefully you weren't too aggressive. Lots of people got really aggressive because stocks were doing real well in 2019, but hopefully you were rebalancing and you have good asset allocation. But if you got really emotional as you started seeing your equities fall, and somewhere in here, you decided that the market was just going to continue to fall forever and go to zero, and you were going to lose everything, even though that has never happened before. And we have seen this kind of volatility before. It's been a while, and we don't like seeing it. But if you exited equities over here, you probably didn't get back in somewhere over here, and you missed out on this incredible recovery. So the pullback was severe and extremely quick. the recovery was just as quick. In fact, the second quarter ending June 30th, U.S. stocks closed out their best quarter since 1998. And we weren't out of the woods, folks. We were still dealing with a recession. We were still dealing with a pandemic. We're still dealing with both of those today. And yet, look at this. The market recovered everything basically on a global basis. All right, let's go ahead and listen. This is quarterly market summary. Really is meaningless as a long-term investor. We really want to focus on 5 years or more, but let's just go through it. We like seeing green. So the second quarter was a nice recovery. First quarter was horrible. So U.S. stocks, and this is a Russell 3000 up about 9.21 for the third quarter. International developed almost 5%. Best place to be for global equities broadly is emerging markets up 9.56. Real estate still kind of struggling, and this is commercial real estate. Well, we all know why. Right now, everybody's working from home. Unfortunately, lots of restaurants, retail environments, and businesses have had to close down, and so they don't need office space anymore. Lots of folks can't afford their office space rent. It's horrible. And so real estate is dealing with that right now. And then the high quality bonds for the quarter, interest rates are very low. When equities do really well, high quality bonds tend to do the opposite. And then since January 2001, sometimes you can get some interesting stories here. So the best quarter for U.S. equities was actually this year, and that was the recovery after the first quarter. But the first quarter wasn't the worst quarter. The worst quarter all the way back in 2008 near the Great Recession. And in fact, prior to this quarter, the best recovery quarter was the second quarter of 2009, which is pretty interesting because very often we see best quarters follow the worst quarters. We see often the best years follow the worst years. And so that was reflected prior to the second quarter replacing the previous best quarter for U.S. equities. Now, for developed international, best quarter was that recovery quarter in 2009. Worst quarter was this previous one in 2020, the first quarter. For emerging markets, this is more like we've seen it in the past. Worst quarter is 2008 Q4. 2 quarters later, best recovery, at least since 2001. And then we see the same thing hold up with commercial real estate. Worst quarter was fourth quarter 2008. And then 2 quarters later, we had the best quarter. So you don't really typically, want to entirely abandon things when they perform poorly, because very often it bounces back in the next quarter or two. Not always, but we see this more often than not. Here is the long-term market summary. And again, we're just looking at quarterly numbers, which frankly are meaningless and don't give us any good insight going forward. 1 year, not much better, but we like when U.S. equities are positive. And if you abandon the market in the last 12 months in that first quarter, you didn't enjoy the great 1 year, 12-month period performance we've seen in broad U.S. equities. International, kind of down, developed, not doing so well over this particular last year, but it is positive. Emerging markets doing pretty well at about 10.5%. And we expected this. Real estate continues to struggle over the last 12 months. Over the 5-year period, look at that. U.S. equities, Russell 3000, averaging about 13.69. International developed, struggling a little bit, historically speaking. Emerging markets doing better at almost 9%. And real estate still being dragged down by the most recent performance. And then the 10-year, this is just beautiful, 13.48%. That's outstanding, because 10 years over the last 94 years, going back to 1926, is only about 11%. So the last 10 years has actually pushed up that long-term average up nicely. And then international developed, still underperforming over the longer period of time. Same with emerging markets. They have struggled. International markets have struggled since 2008, 2009. And then real estate, this number was above 10% prior to the most recent performance. Here is another good lesson. So this is broad U.S. bonds. That's going to include governments, which are guaranteed very high quality. It's also going to have some corporates in there, lower quality, no guarantees, certainly not the full faith of the U.S. government. The reason they are up so much is when the market is very volatile, there is a lot of investors who move into fixed income because they don't like the volatility. That demand drives up the cost of bonds and you get a nice appreciation there. That appreciation isn't going to last forever. Here's the lesson though. Over the last 10 years, U.S. bonds, even with this really nice last year, and this is a pretty good 5-year period when interest rates have been as low as they are, over 10 years, you're barely outperforming historical inflation, which is about 3%. And that's why you need some equity exposure long-term in your portfolio. All right, let's go ahead and look at world asset classes. S&P is right here. We're looking at the Russell 3000 in the previous slide. That's where that 9.21% is. I think what's interesting is in the first quarter, one of the worst places you could be in global equities was emerging markets. Now it's one of the best places to be. When everything equity, all stocks across the world are doing fairly well, we can expect high quality issues to be underperforming. And so those are your safest. Well, this one's real estate, but these other two are bonds. All right, let's go ahead and move on. I guess what's interesting here is if you have a diversified global approach, here's the U.S. at 9.21, that's the Russell 3000, but we have lots of markets that outperformed the U.S. on the developed side and then on the emerging side. And so if you take that broad global approach, you're always going to have the winners. You'll also have some of the losers, but remember, sometimes the losers become the winners and the winners become the losers. So you want a good rebalancing strategy. I guess another thing that's kind of interesting here is there's China, okay? They started, the pandemic started in China, and they are performing, at least in the quarter, better than the U.S. equity market. All right, so let's go ahead and look at U.S. stocks. I always like pointing out that the U.S. accounts for about 57% of all global market cap. So a simple way of looking at is we're about $33 trillion of the global potential for publicly traded companies. So 57% of the value of all global publicly traded companies are domiciled here in the United States. So that means the balance of that 43% are investment opportunities outside of the United States. And we really went into some of that data and why having international exposure is important over longer periods of time. It adds performance in the previous presentation, pursuing a better investment experience. Okay, so for the third quarter, and we're looking at third quarter here, best place to be is large cap growth. And I think of FANG when I see large cap growth doing as well, being the best place over the last quarter. And so I'm working on a presentation called Large and in Charge, where we're going to go through the super stocks, not only the FANG and their recent performance over the last several years and how they may perform going forward when we compare that to some of the previous super stocks all the way back to the 1930s when AT&T was the super stock. That was the technology stock of the day in the 1930s. So we've seen these super stock, super performers over time. And so we've got really good research as far as how they perform leading up to a super stock and then what happens once they become one. And I think you'll find that interesting. All right. So, but over the last 10 years, large cap growth has done well. We did cover this in the previous presentation that value has just been struggling over the last 3 years. Typically, we see value outperform growth over longer periods of time, more often than not. Small cap, we see outperform large more often than not over longer periods of time. And those two relationships have just broken down. And we'll continue to watch that and report on it. All right, international developed. Again, the U.S. is about 57% of the global market cap. International developed is about $17 trillion and about 30%. Again, we see that growth is outperforming year to date, and we see value also consistent with domestic stocks underperforming over the last 3 years or so. What is unique is during the quarter, small cap is outperformed. All right, let's take a look at emerging markets for the quarter. We also see small cap outperforming, and we see that in developed, which in the previous slide. And we see the same consistent underperformance with value over the last 3 years. And then emerging markets are about 12% of the global opportunity and market cap for publicly traded companies. All right, let's look at real estate. Now we have domestic real estate, which is about 61% of global REITs. REITs are real estate investment trusts. Those are publicly traded, typically commercial, not always, but typically commercial real estate. And the balance of that is international, about 39%. And over the last 3 years, real estate has just not done so well. A lot of that is related to the effect of the pandemic, and we expect that to persist for some time. But we're not going to entirely abandon real estate, because probably before the data suggests it's time to get back in, real estate will already be recovering. Let's take a look at fixed income for the third quarter. All right, when we look at the bond yield, I think what's interesting is we see the highest yield is state and local municipalities. And we got to remember our seesaw here. So we got interest right here, and that's yield. And you got dollars here, and that's the value of the bond. So when bonds lose value because people sell them, so the price is lower, the yield goes up, right? So this has a higher yield, and it's a muni. I'm wondering why the price has gone down. Maybe it's because of the budget shortfall risks related to COVID, and everybody's waiting for the federal government to come up with some stimulus package to help out state, local municipalities. And I bet you investors see some risk there because they can't seem to get that done. So that's kind of interesting. Not surprising that the highest quality stuff has the lowest yield. You would expect that. We would also expect that in an environment, and these are periodic returns, where the stock market is doing well in the last quarter, right? And even over the last year, and even over last 3 and 5 and 10 years, because we saw those numbers in a previous slide. So it's not surprising that high yield bonds are outperforming all the other ones. And what I imagined in the halftime report happened after the first quarter, or within the first quarter, lots of investors were chasing yield, and they bought high yield bonds because they thought all bonds are the same. And what they didn't realize is when the market crashed in March, they saw their high yield bonds go down 10, 15, 20% or so. And so you've now had 2 really good quarters where high yield has recovered, hopefully all of those losses that you sustained. And this might be a good opportunity, if you've learned this lesson, to rotate out into higher quality stuff. So when the market's doing well, we expect the higher quality stuff to underperform as well. All right, let's go ahead and look at diversification. Now, Hopefully you have heard me talk about this relationship between risk and return. And it's an economic principle. And the way, let me get an R there. There we go. The way it goes is over time, if you have good diversified risk and you take on more risk, you would only do so if you thought you had a really good chance at increasing your return. So when we look at portfolios and we measure risk, we use this thing called the standard deviation. And so as the standard deviation increases, 0.23 for T-bills, which those are the safest investment on the planet. But as the standard deviation gets higher, it means that risk is also growing. And so as risk grows, we want to see performance grow too. So let's see how that works. So as we add more risk, well, it seems to work out. So an all equity, all stock portfolio over 10 years averages 9.13. A less aggressive portfolio that has 25% in bonds underperforms. As we add more safety, underperforms that. And as we even pile on more safety, it continues to underperform. Conversely, as we add risk, we get more performance. So that is a good representation of that economic principle. Same thing over 5 years, because 10.9 beats 8.58, which beats this, which beats that, and that beats that, so that holds up. 3 years also holds up because that beats that, and that beats that, and that beats that, and that beats that. And even over 1 year, and we expect this to break down, over the shorter periods of time, but it holds up over 1 year as well. Breaks down over year to date, but we don't care. These are speculators. We are an investor, so we really want to focus on 3 years or more. Actually, we really want to focus on 5 years or more. All right, so let's go ahead and take a look at this slide. All right, I promised you 2 slides related to this crazy presidential election. We've got less than 3 weeks to go. And the theme behind the slide is that markets have continued to reward long-term investors under a variety of presidents. And so these blue sections are Democrat administrations. Red are Republicans. Looks like a growth of wealth chart, basically is. And we can see a nice 30-degree, maybe that's 35-degree incline. And it's hard to tell the difference between the red administrations and the blue administrations. And it's not surprising because this is covering 94 years. And we know that over 94 years, the S&P 500, that's what we're dealing with here, has averaged 11% a year. It's up about, so it's up about 75% of those years. That's a 7, not a 2. And in those years that it's up about 20%. I hope you can follow this. And so the challenge for us as investors is we get emotional about our football team and our kids' soccer team, and we get really emotional about our presidential team or our political party because they spend a lot of money to make us crazy and emotional. And what you don't want to do, look at the data right here, look at this information. You don't want to make financial investment decisions based on whether your team won or lost, because in the end, they all win, okay? All right, I've got one more slide, and this just shows the different terms of an administration. So for example, Trump's only had 1 so far, okay? Obama had 2, so that's kind of how that works. And I guess the main point here is we have 1 term down, 2 terms down, 3 and 4, okay? So it's fairly rare that a 4-year period is negative. All the other ones are positive. So just look at the data, make decisions based on data, and hopefully this election's going to be over. It would be nice if it would be over sometime in the evening of November 3rd, but who knows? This is 2020 and something crazy is going to happen. I'm sure of it. In closing, thank you for your time and attention. I certainly hope you learned something. So while equity markets have generally recovered well since the first quarter, we are by no means out of the woods from an economic standpoint. This recovery will certainly take some time. So it's critical that you understand and follow the investing principles that stand the test of time. First of all, we live in a very noisy world. So look past the headlines and do your best to control your emotions so you can stay disciplined when it really counts through any market dips and swings we may experience in the future. Focus on the long-term drivers of return and let the market work for you in an appropriately diversified portfolio for your needs and risk tolerance. All of this is even more important today because we are in the final weeks of a presidential election. So do your best to tame that emotional investor that we all have inside of us, especially if your party does not come out on top. Because in the end, historically speaking, both parties have enjoyed fairly even performance. So while you may be unhappy if your party loses, I would not recommend making a major strategy shift as a result. The best course of action is to remain disciplined for the long term. Now, please follow us and like us on social media where we post these kinds of videos and other content, and go out there and have a wonderful fall season. And of course, watch that candy consumption on Halloween.